Hey, what's going on guys? Welcome back to Kiwoon Learning. I'm Caleb, and today we'll be going over how to find undervalued stocks. Over the years, I found 5 easy steps that truly anyone can use. And in this video, I'll be breaking down these 5 steps through stock fundamentals, analyst ratings, and an example of how you can use this process. But before we get into this video, if you guys are enjoying the content, make sure to hit that like and subscribe button down below. Now let's get right into it. Step 1. The first thing you want to find is a stock screener. I'm currently using a screener from YCharts, but if you do not have an account through them, I strongly suggest using vids. Vids has a really nice screener and it covers thousands of stocks. And the fundamentals I'm about to go over are exactly the same. The reason why I'm using YCharts is just that the user interface is a little bit easier to use and to see. And I'm going to go over a lot of fundamentals rather quickly. So if you guys are wondering more about what certain ratios mean or what they do, we'll have some of our educational videos linked down below. The first metric we want to be looking at is return on equity. We want this at least 15%. This is because for undervalued stocks, we need to build a strong base in their fundamentals. A 15% or above on return on equity shows strong ability in management to generate income based on the total equity that they have available to. Next, we have our price to book ratio. And this metric is really useful because we want this to be anywhere between 0 and 1.5. It is because a lower price to book ratio could indicate that a stock is undervalued. And when the typical range is 1 to 3, going on the lower end of this range can be really useful in determining the best value at any given moment. We now have price to sales, or the P to S ratio. We want this to be anywhere between 0 and 2 because this ratio shows how much investors are willing to pay per dollar of the sale of a stock. Typically, if a stock has a price to sales over 2, it is trading for a premium. Next, we look at debt to equity. This, in my opinion, is one of the most important ratios. This is because we have this range set between 0 and 0.5. A lot of people like looking at 0 to 1 or 0.5 to 1.5. But the 0.5 is really important because having low debt to equity shows that a company is healthy in terms of their liabilities and equity. Although, in recent years, others have concluded that too much leverage is just as bad as too little leverage. Too little leverage can suggest a conservative management unwilling to take risk. But in my opinion, high return on equity can make up for the conservative management if they are producing their returns. Now we have price to free cash flow, another one that not a lot of people teach, but this one should be anywhere between 1 and 15 or 0 and 15, and this is because it means that a company has high free cash flow compared to the amount of stock that they have on the market or total equity. High free cash flow is good because companies can give out consistent dividends as well as stability in times of market downturn. And lastly, we have volume. Again, a ratio and a metric that people very much overlook, but this is really important in trading because it is not something that a lot of people teach. Having volume over at least 100,000 is actually really important so that the stock doesn't swing based on high volume, and when it does come, it is more sustainable when it moves up or down. Now, after you put in all these metrics, you get essentially a few stocks or a few symbols on the bottom left, and you get essentially their names. Now, I've done a little background research already on these 4 stocks, and it seems that ORI, or Old Republic International Corp, may be our next undervalued stock. Now, I know this is a long step 1, but trust me, their other 4 are very short. Now, let's get on to MarketBeat. MarketBeat is essentially an analyst rating or analyst website that a lot of people use to just see what people put price targets at. And as you can see here, there's one analyst putting a price target of $30 a share, with over a 22% upside. So while this is really good, we don't only want to select ourselves to a single website. In step 3, we look at another website, for example, Tipranks. Tipranks now has other analysts that rate the same stock. They also give it over a 20% upside with a target price of $30. This can also possibly show that with now our background research and putting those metrics in, that Old Republic may be undervalued. And now in step 4, we want to check if this company has any dividends. And as you can see down here, Old Republic actually has a dividend of 3.6% every quarter, which can actually amount to over 14% every year, even if the stock makes no moves at all, which actually is almost double of what the S&P 500 has done historically. And finally, in step 5, we have to look at their trading. And this is because not only do we want to find undervalued stocks and growth stocks, we also want to be looking at how to actually trade that stock. I really like using websites like TradingView because it makes it really easy to use and to show what possible price points that you should get in on and what possible oscillators, and moving averages you should be using. And so with this, you can launch the Old Republic International Corporation chart, and with this you can see their summaries. And as you can see here, Old Republic is a buy in the month, the week, and the day. And their moving averages are really strong with that. But yeah guys, that's actually basically all I have. I'm not saying ORI is a definite buy right now, but it definitely looks more appealing than other stocks out there, according to this process at least. I would make sure you do your own research beforehand before you make any trade. But I hope you guys enjoy the process I use from time to time to find undervalued stocks, and hopefully this can be helpful to you guys as well. Hope you guys have a great rest of your day, and peace.